We all know that a visit to a bank branch can bring a variety of emotions, but the average consumer has no idea what goes on behind the glass windows of their bank's local branch, which is why we've decided to take a closer look at some of banks' best-kept secrets. First up, banks can take money from your account without asking. A right of set-off is one of the biggest banking secrets on the list that can destroy your finances if you're not careful. It generally happens when you have a deposit account and a loan at the same bank. Also referred to as a banker's lien, a right of set-off grants the bank permission to access funds in your deposit account automatically and without notice if you're late on a loan payment. When you deposit money into the bank, you are essentially lending money to the bank with the promise that they'll pay you back when you ask for it. The best thing to do to avoid such circumstances is to make timely payments towards the loan, and if you're still concerned about your money, then you can transfer your funds to a third-party bank. Next, you can negotiate credit card rates. Credit card rates are going to vary tremendously between creditors. Some will offer introductory rates as low as 0% APR, while others can climb well over 20%. Plus, many credit card companies offer intriguing incentives to entice you with their business, like rewards programs, frequent flyer miles, or cash back. For example, if you're trying to decide between two credit cards, one of which has a low interest rate of 10%, while the other offers rewards points with a slightly higher interest rate, then call the card company with the rewards program. Once you're on the phone with the credit card representative, explain your situation and how you received a better offer from their competitor at a drastically lower interest rate. The company rep will likely work towards matching their competitor's offer. Number 3. Post-dated checks aren't foolproof. A post-dated check is far from being a sure thing. In fact, some customers were surprised to find out that their bank processed a check before the date that was written on it, which resulted in penalties due to a lack of funds in their account. Typically, banks agree to refund their clients' money and cancel the check, but it's not always easy to get them to see it your way, and you're probably going to spend a lot of time just trying to explain this situation. Thanks to automated payments and online banking, the majority of us, if ever, write checks, but millions of Americans still put out their checkbooks every day to pay the bills. Even though it may not seem right for a bank or credit union to disregard the date written on a check, they aren't legally required to honor the request to postpone processing transactions unless certain conditions are met. The only way to possibly prevent a post-dated check from being processed early is to let everyone involved know in advance, and in a format that goes beyond just post-dating the check. Also, banks and bank employees have targets to reach. Unfortunately, no matter how friendly your banker may be, they're not your best friend. They have daily and sometimes even hourly targets that they have to reach, and sometimes the pressure to hit these targets can force them to offer clients products that they don't really need. Also, with massive quarterly earnings and senior management freely admitting that their business objective is to increase value for shareholders, it's clear that banks care more about their own interests than those of their clients. They want to make sure that they're getting the most from you at each turn, which is why they sell you products that you don't need. However, it's also important to remember that bank employees can become seriously stressed from their job. A CBC investigation into employees at Canada's 5 big banks found that some employees were so stressed about reaching their sales targets that they had to go on medical leave. Meanwhile, others suffered from insomnia, anxiety, and depression. And it's not just Canadian bankers, as similar situations have been reported in the United States as well. Number 5. Debit cards carry higher liability. When given the option between credit or debit, you don't have to look far to see why the convenience aspect of the debit card is what makes it so widely used, even if you're putting yourself at greater risk. Credit cards and debit cards have differing liabilities associated with them. If you choose a credit option, then you'll be protecting yourself from fraudulent activity under Visa or MasterCard's liability terms. For credit card fraud, the maximum liability under federal law is relatively low, and in most situations, like with a Visa transaction, you'll have zero liability on unauthorized charges. However, with debit cards, timing is going to be essential when it comes to fraudulent activity and determining the maximum out-of-pocket liability you're responsible for covering. Your ultimate liability will depend heavily on your individual situation, but generally, you'll only have a couple of days to report your card as stolen to limit your liability to the minimum amount. By extending it beyond 2 days, you could be liable for a rather large sum. Next up, your bank may not be the best place to invest your money. Even though this may seem counterintuitive, your bank isn't always the best place to invest your money. Bankers often can't offer all the savings and investment products available on the market, so you could very well find a better product for your situation that your banker would not be able to offer you. Bankers have very limited investment options because the bank will have their own mutual funds or those of their partners for you to pick from. from. You won't have nearly as many options as you would if you elected to go with a discount brokerage firm, for example. When your investment choices are limited, you're much more likely to run into some more expensive investment options as well. When your bank steers you towards their own investment options or those of their partners, you are not going to get the most competitively priced options. Also, keep in mind that banks are in the business of taking in deposits and loaning out that money while paying nominal interest to the deposit holders. They're not in the business of helping you invest money for the long term, and they're not in the business of putting together a powerful trading platform for you to utilize. Banks will either minimize the technological investment in this area or end up buying a secondary firm to help them make up in this area. Number 7. Banks want you to walk into their branches. When you walk into a branch, the teller generally seems thrilled to see you, but don't be fooled, there's a bit more here than meets the eye. Tellers always seem to be pushing for you to open new accounts, but that's because their jobs depend on it. They're all salespeople, and they all have quotas to meet, so each new account you open means they'll receive some sort of commission. Tellers also require to send a certain amount of customers to the personal bankers at their desk, and the biggest commission bankers receive is on larger deposit accounts. To avoid being upsold on accounts, adding extras that you may not need, try to do all your banking online. And if you've got any questions, just call customer service. Also, the more you swipe, the more money they make. Every time you swipe your card, regardless of whether it's debit or credit, the bank is making money from charging the merchant certain fees. Promotional credit card offers will often want you to spend a certain amount within a time frame in order to be rewarded. Although it's a great deal for you, they're doing that for their own benefit because the more you spend swiping your card, the quicker the banks make their money back from rewarding you. Also, banks are counting on the fact that once you've racked up the $1,000, you won't be able to pay it all off in 1 month, creating additional interest fees. Number 9. A closed checking account can come back to haunt you. I'm guessing that when you close a checking account, you assume that it's, well, closed. But that may not be the case. There have been countless instances in which customers closed their checking account but forgot to switch over their autopay transactions, which caused their closed account to be charged anyway. This resulted in customers having to pay fees, penalties, and in some cases even turned over to collection agencies. The Bank of America eventually changed their policy due to the number of complaints, but not all banks have taken such measures. And finally, there may be a way you can avoid checking account fees. A lot of big-name banks charge a monthly fee for your checking account if you don't maintain a minimum balance. When you receive money via direct deposit from a company or the government, it's sent through an electronic network or automated clearinghouse. However, some banks categorize those payments and all other bank transfers as PPD, prearranged payments and deposits, in which case you can deposit money from PayPal, online savings, or other accounts. When you check your bank statements, be sure that it says PPD next to the deposit, and if so, this will fulfill the requirement for direct deposit, waiving your monthly fee. And with that, it wraps up the video. Thank you for watching.